Now we are going to discuss about effective use of margin rules for option trading. There are different types of trades possible in futures and option segment. In futures, positions can be bullish or bearish. When we are bullish, we buy futures, it is called as futures long. When we are bearish in underlying, we sell futures and it is called as futures short. Then futures can be hedged, and hedging futures is with options. So when we have bullish view, we can buy futures, that is called as futures long, and this position can be hedged using puts. To hedge future long, we have to long puts, means we buy futures and we buy put. This is one type of hedge for long position in futures. Then there is another hedging where we are long in futures and it is hedged with selling call. So call short and future long is also bullish position which is hedged. When we have bearish view, then we can take future short and it is hedged with call long. So bearish position is future short and call long is bullish position, means this position is hedged. When we have bearish view, futures are shorted and this can be hedged with put short. Put short is bullish position in underlying. So to hedge bearish futures position, we can go short in puts. These are 4 basic types of trade possible in futures segment. Now let us see what are margin implications of hedging futures position. We will see this with different examples in stocks as well as in indices. I use Zerodha account just to know how much margin I am going to need. Here in orders, we can go to basket orders and create new basket. Can name it whatever we want, we can give it a name. Suppose we want to go long in futures of Nifty. So we search Nifty future January. Here we can see margin required for future long one lot is 1,06,997 rupees. If we sell futures, around same margin is required. So whether we are long or short, around 1,06,000 rupees, 1,07,000 rupees are required. So whenever we want to trade in Nifty future in one lot, we need 1,07,000 rupees. Now this is futures long, and if we hedge this position with put long, Nifty 17,700 January put. If we buy this put, you can see margin requirement is just 50,000 rupees. Margin has decreased by 50% or so. Here original margin requirement will be 1,20,000, but now margin requirement is 50,200 rupees. Suppose if we hedge with weekly option, what will happen? We are buying 17,700 put at market, and here margin requirement is just 38,000. Why is it so? Here we can see that margin requirement is just around 39,000 rupees. If we hedge this position by selling a call, what will happen? If we hedge this position by selling monthly call, margin requirement is not decreasing, it is almost same. But margin requirement for call selling is not added. Extra margin requirement is not increasing too much. If we short weekly option, 17,700 call sell, here our margin requirement is higher. Why is it higher? Because protection provided by Nifty 17,700 call is less. Because of this, margin requirement is higher. This was for long position. Now let us see for short position. Instead of buy, we modify it to sell, and margin required is 1,06,000. Now there are two possible ways of hedging this. One is by going long in call. We are short in future, so we are going long in call. 17,700 monthly call buy. Here margin requirement is just 32,000. So if we short one future lot and buy one call, then margin requirement is just 32,000. And instead of buying monthly call, if we buy weekly call, instead of buying monthly call, we are buying weekly call. What is the margin requirement? It is just 19,400. Okay. Now instead of buying a call, we want to go short in put, and we plan to sell 17,650 put for weekly expiry. Here I have added short position of 17,650 put for weekly expiry. Margin requirement has increased, it is not decreasing. If I short 17,700 put for weekly expiry, my margin is not decreasing much. If I short monthly put of 17,700, then margin required is less than that required for weekly put option. This is because monthly put has higher premium than weekly put, so protection provided is more. Because of that, margin required is less. Now let us check this for stocks. Suppose we want to go long in Reliance. Margin required for Reliance is 1,38,000 to go long in one lot. Now if we hedge this position, what can we do? We can go short, we can go long in puts. So if we buy 2340 put, Reliance is trading at around 2433. If we buy 2440 put, which is slightly in the money, our margin requirement is decreasing from 1,38,000 to 53,600. Margin requirement is decreasing. Total margin required for this position will be 1,55,000, but because of margin benefit, only 53,600 rupees will be required to initiate this position. And if instead of buying a put, we sell a call 2420 to hedge, what's happening? Margin requirement is slightly increasing, but there is some margin benefit. Total margin required will be 1,60,000, but here we need only 1,42,000, 1,43,000 rupees. Okay. Now let's come to options. What are different trades possible in option segment? When our view is bullish on underlying, we can create different option positions, which are we can go long in call or we can go short in put. These are simple basic option positions. When our view is bearish, what we can do? We can go long in put, that means buy put, or we can short a call. So these are 4 basic option positions. What are different bullish option positions? Call long naked is bullish position, put short naked is bullish position, then call long which is hedged with higher strike call short of same expiry or different expiry. This is also bullish position where we are selling higher strike call so that our losses are decreased in case there is no movement but upside is limited. Then there is another strategy where we can short put, where we can short the put and it is hedged with lower strike put long of same expiry or different expiry. Here what do we achieve? Downside protection is achieved. When put is shorted naked, then downside is not protected. If there is gap down, then we will lose lot of money. But when lower strike is bought, then we have protection for lower side and losses, maximum losses are limited. These are bearish options positions which are put long naked, call short naked. These are basic positions. Then we can go long in put which can be hedged with short in lower strike put of same expiry or different expiry. And then we can short a call which can be hedged with higher strike call long of same expiry or different expiry. So these positions can be created for bullish or bearish view. Whereas for non-directional trades, naked call short along with naked put short simultaneously can be taken. Then there is possibility of call short with higher call buy and put short with higher put buy. There are names for these strategies. We will discuss these in strategies section. Then one can simply buy a call and buy a put of same strike or different strikes at same time. These are non-directional trades. Now let us see implications of margin